Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're looking at the trajectory of interest rates for the coming months. This is widely covered in the mainstream news. If we only repeated what you could read in the Wall Street Journal or on CNBC, then this show wouldn't be adding any value. So we're going to dig a little deeper into the analysis of the Fed Chairman's remarks to the Senate Finance Committee earlier this week. Try and make sense of what it means for real estate investors. There were two major items of business at the Senate Finance Committee this time around. Number one was to get the economic update and statement from Fed Chairman Jerome Powell, and second was to confirm Janet Yellen as Treasury Secretary. Janet Yellen was chair of the Fed before the appointment of Jerome Powell, so she's interacting with her counterpart in the Fed from the perspective of someone who used to occupy that chair. When Janet Yellen was chair of the Fed, she was beating the drum about the need to print money to keep the economy healthy. Now, as Treasury Secretary, she's beating that drum even louder, even before being formally confirmed in the position. Now, before the Senate Finance Committee meeting, we've been seeing a lot of market activity. The low interest rate environment is driving demand for refinancing of debt into lower cost debt. I can tell you from conversations I'm having with lenders that their origination desks are overflowing with demand for refinances. This is true at traditional banks, commercial lenders, and even loan insurers like Fannie Mae, Freddie Mac, and HUD. The Department of Housing and Urban Development divides the nation into regions, and they service loan requests from each of their regional offices. I'm hearing that the HUD office in Fort Worth, Texas, has such a backlog they won't even assign an analyst to look at a file for 3 weeks after receipt of an application. The delay in the San Francisco office is now more than 6 weeks before they'll look at a new file. The money printing has put a lot of cash into the system, and the Fed's comments on inflation mirror the December statement where they said that they were willing to have inflation achieve an average of 2%. That's their target. What that means is the government is knowingly devaluing the currency, but the word average was attached to the target of 2% inflation. The reported rate of inflation was 1.3% when measuring personal expenditures. The core rate of inflation, which also excludes food and energy, was 1.5%, and they said both these were less than the total inflation, although they didn't actually report that number in the remarks. I'm going to quote directly from the published remarks by the Fed chairman. Achieving inflation that averages 2% over time helps ensure that longer-term inflation expectations remain well anchored at the longer-run 2% objective. Hence, following periods when inflation's been running persistently below 2%, appropriate monetary policy will aim to achieve inflation moderately above 2% for some time. So this means they're going to hold interest rates low even once inflation is shown to be above 2% for a period of time. They reiterated the intention to continue the current stimulus until late into 21 and likely into 2022. Fed Chairman Jerome Powell said that strong demand is driving Treasury bill yields close to zero. He said there's a lot of liquidity and people want to store it in T-bills. And Powell went on to say that Treasury instruments are the concern of the Treasury Department. The Fed is more concerned about keeping the target rate in its range from 0 to 0.25%. So he recognized where all the extra cash is ending up. He basically said it's Janet Yellen's problem to issue the Treasury notes. Paradoxically, the yield on longer-term Treasury notes has been rising in recent weeks. It's an indication that the sentiment of inflation remaining low is not being widely accepted by the market. The dollar is losing value against all the major currencies, and the yield for the U.S. Treasury is going up, especially the longer terms. The benchmark note jumped to 1.5% on Thursday afternoon after investors showed weak demand for $62 billion of the 7-year notes. The 10-year note climbed another 15 basis points to 1.54%. Bond prices move in the opposite direction of yields. Now, Peter Boockvar, Chief Investment Officer at the Bleakley Advisory Group, is someone who I follow regularly. I've met him a few times at the New Orleans Investment Conference. He described the 7-year note auction as an awful result after it tailed by 4.2 basis points. That's the most in the auction's history. Now, the tail is the gap between the highest yield that the Treasury sold in the auction and the yield before the auction began. So the price went up by 4.2 basis points from the start of the auction until the end of the auction. It's a signal that international investors and perhaps the investment community at large isn't buying the story. It's clear that government wants low interest rates to continue. Question is whether the risk premium being attached to the US dollar will allow that low interest rate policy to continue. The 10-year Treasury hit a high of 3.2% back in October of 2018, and it's been falling ever since, hitting a low of 0.5% in the summer months and back in 2020. But the rate has been rising steadily ever since. And the reason we focus on the 10-year Treasury is that most permanent financing interest rates are based on a rate lock that is tied to the yield on the 10-year Treasury. That one interest rate is super important for us as real estate investors. I don't really want to be one telling you to go follow the pack, but at this point in time, my recommendation is that it is time to follow the pack and get your refinances done, get into your permanent financing as quickly as possible, because guess what, folks? Rates are heading up almost regardless whether the Fed chairman says that they should go up or down. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.